Welcome to Money Hangout once again. Uh, every week we interact with you to help you understand mutual funds better and answer some of the questions that you may have. Today we are going to talk about something which, based on the whole idea came from the big campaign about mutual fund awareness, which was launched by the trade body of mutual fund, which is AMFI. Uh, AMFI launched a awareness campaign about mutual funds, which is Association of Mutual Funds of India. And we started watching some small stories, 30-second, 40-second stories, where one of the other people in the conversation tells it the whole ad, the campaign, the individual ads, they conclude with mutual fund Sahi hai. And this has the potential to raise great deal of curiosity, great deal of awareness. A lot of people will start asking, but I know what people end up asking. I face this question all the time, that once somebody has understood that mutual fund is something worth considering, then the next question is, Kaunsa mutual fund sahi hai? Which one to invest in? And I think a significant, the biggest contributor to this question, or the answer to this question, is not, I cannot give you this answer. I don't think any expert can give you this answer. I think the expert, you are yourself the most important person who should contribute to seeking that answer, because uh, choosing the best fund comes after, once you have decided which kind of fund that you require. And this is primarily dependent on two things. One is your investment time frame and your own experiences. By experiences, I mean, if you have never invested in the market, if you are not aware of, or if you have never experienced the volatility of the market, if you have not known it for a while, then your attitude, or your reaction to what happens to market linked investment might be very different. Once you are, you have been invested, and you have invested for 2-3 years, and you have seen market go up and down, or the way you have invested in the past, that is a big contributor to your dislikes and likes, and your ability to stick to your plan. So choosing the best fund will disappoint you if you are not choosing the appropriate fund. So with that in mind, uh, you have to decide it first. What kind of investor are you, and for how long are you going to stay invested? When are you going to, likely to need that money? This is most important thing. Then comes the best fund for you. And this is where value research has played a critical role. Since 1993, we started rating mutual funds, and mutual fund ratings in India, uh, the Indian investors trust this rating. They have used it as a guidance, and we have refined this methodology over a period of time. This is the oldest guidance which has been available to Indian investors and available in the public domain, and investors use it very intensely, some for the right reason, some for the wrong reason. And today I am going to, as a step towards the, Kaunsa mutual fund sahi hai, how mutual in value research mutual fund ratings plays a role in helping you choosing the best one, choosing the right one, choosing the appropriate one. One is to, before I get into how to use it, an important thing is to understand what this mutual fund rating is. Mutual fund rating is nothing but a composite measure of risk and return as well. Everywhere you see the return, everybody knows that this fund has given 20% return over the last 1 year, 25% annualized return over the last 5 years, whatever. These numbers are available, but you have plenty of numbers available. Then you also get a sense of, the character of the fund, how the price behavior has been over a period of time, depending on, how volatile it was. And, you will get a lot of pointers to how this fund, how various funds, with various ratios, Sharpe ratio, alpha of a fund, which basically tells you how the fund has been able to, what kind of value it has been able to add beyond the systemic risk that it assumed. So all those are fine. But because there is a plenty of things to choose from, we devise these ratings as a composite measure of risk and return, so that it is basically an assimilation of many variables. You look at a fund which goes up from 10 to 20 with great stability, and another fund which goes from 10 to 20 in the same period of time with extreme volatility. In our method, the fund which does it with great stability will get a 5-star, and there is a possibility, depending on the magnitude of ups and downs in the life of the fund, with similar return, that fund can well give you exactly same return, but can get slotted as a 2-star fund. And there is a reason to it. Why we did it was, investors' distaste for negative return more often, as demonstrated in the past of a fund, is far greater than the positive return. Let me just explain you. If an investor gets 10% return, your 100 rupee becomes 110, you feel happy. But your 100 rupee becomes 90, you become very unhappy. So our distaste for negative return, our distaste for our loss aversion, our distaste for the decline in value is far greater, and that affects our behavior. And this is what we have tried to factor in our rating. Then comes how to use these ratings. Of course, there are a few other things. One is that all these ratings are valid only for a certain kind of fund. So when we are talking of large cap fund, the fund which invests only in large cap stocks, it is valid only for that. So don't do a cross comparison. A 5-star small cap fund is very different from a 5-star large cap fund, or a 5-star short term debt fund is very different from a 5-star dynamic bond fund. So they are all within the category. The rating is primarily trying to tell you is that these are the funds among a bunch of similar kind of fund, which have done better with greater consistency in the past 3 years, 5 years, 10 years, and so on. Then comes how to use. Of course, there's one more advantage, that we do not rate funds till we have enough number in a category. So unless there are 10 funds of a similar kind, we do not do the ratings. Until the funds get at least 3-year-old, we do not rate those funds, because a fund must have some meaningful background for you to actually form an opinion, even on its price, on its uh, on its the way it has attracted its benchmark, the way it has done against its peers. So these are two things. This in itself actually causes brings in a very desirable filter. How to use these ratings? I would say that don't use these ratings as the only way to look at it, to choose a fund. But these ratings are very useful from two standpoints. One is that they help you weed out a crowded universe. There are 50 large cap funds, there are 70 large cap funds. And it's not possible for you to analyze and look closely all these 70 funds. So knocking the lower rated funds, you have a more credible history. You have a credible list, smaller universe for you to choose from. And once you come across that smaller set, apply your thought on 2-3 things which I will state little later. But 2-3 things which you have to see after rating. But before that, it helps you limit your universe. The other thing which the rating does is, we do a continuous monitoring. Once you have invested based on a rating, after we have invested in a fund, we don't know when to actually revisit it, when we should review it, when we should review our decision, that have we done a good job. Rating acts as a good reinforcement. Once you have invested in a 5-star or a 4-star fund and it remains like that, which means this fund continues to do well relative to others in somewhat the similar way. And because it is a broader bunch, we are not giving a precise ranking. When you are looking at a ranking, it can still be confusing. You are looking at 1 out of 72, 2 out of 72. So you can't make sense of, is 7 out of 72 is bad or good. By bundling them together, a 5-star is basically top 12.5%, which I think is a good enough rough bundling of, because it's very difficult to guess which one will be the best one it is very hard to guess which one will be the best performing fund. And in fact, if you ever get to figure that out, that this fund is going to be the best performing fund over any time period in the future, do nothing, invest only in that fund. But it's very difficult to do. I would say that it is impossible to do. All we are trying to do is remain invested in a good fund and be wary. You will get an alarm, or you will get an alert or a gentle reminder based on use the rating change as a gentle reminder for you to review and revisit. And because we revise these ratings every month, you should use it like that. After you have chosen, you have zeroed in on a smaller universe, 3, 4, 5 funds of the right kind for yourself, then you should look at 2, 3 things. One is that, is the fund manager, because our ratings do not factor fund manager changes. So is the fund manager still there, and has he been around? Because if you are looking at the 5-star fund and the fund manager left 3 months back, I would say that the likelihood of that return being sustained over a period of time may not be as high. So it should definitely be on your alert. You should be watchful. So fund manager, you should still be wary about. And next important thing is, once you have looked at the ratings, you have looked at the fund manager, then I think looking at how clearly that fund has devised its process in terms of has the fund articulated its don'ts, what the fund will not do and what the fund will always do. I think these rules comes in very handy. A great fund generally happens to be the one which is managed by a skilled fund manager who is bound by a rule, because most good fund managers, if they are not bound by the rules, they go haywire, or they get indisciplined, or they go wrong somewhere. Some of those rules actually comes in very handy. Which are the kind of stocks, or which is the kind of segment of the market which the fund will not invest in? What the fund will never do in its life? What kind of stocks will the fund always choose, or what kind, so having those, if you come across those articulated rules, go for it. If you don't come across that, I think that is something which I really wonder that will be sustained over a period of time, irrespective of fund manager changes. So these are 2 things. And then the life of these ratings, how long this fund has been a superior performer on a risk adjusted basis. One is to look at the rating itself. The other is how well it has done over a period of time, the longevity of these ratings, sustainability of these ratings. If a fund has been a 5-star and has been a 5-star for a long period of time, I would say that the fund has been doing something remarkably well to be there. So these are the rules which you should follow, and I think you are well on your way. We provide you all these things so that you can yourself choose the best fund. Kaunsa mutual fund sahi hai, you can figure it out yourself. You have the best incentive to do this, and it is not very hard, because value research provides you the ratings, the changes in the ratings every month, and all the information which will equip you to pick the right one. There are 2, 3 things which you should have in mind, which I think it is important for you to understand. That limitation of the rating. The rating is based on past performance, and this is past performance. Future is uncertain. So this is something which you should have in mind. The other is that we are, with full understanding, we like a fund, or we think that it is a better fund if the fund provides greater stability. And our definition of stability is that the unstable funds are the ones we penalize. We penalize a fund which goes down more often. If a fund declines in value more often relative to its peers, we dislike those funds. So if there is a possibility that there is a fund which goes up from 100 rupee to 300 rupee in 5 years time, and there is another fund which goes up from 100 rupee to 200 rupees in 5 years time, but there is a possibility that the one which has gone from 100 to 300 rupee with extreme volatility, with extreme wildness, it may not be the top rated fund. it may not be a 5-star fund, but the fund which has done with great stability might remain a 5-star fund. So just take it to your heart that this is a composite measure of risk and return as well. And most of the time, we are guided or we are attracted by the returns only. Risk is important, and on a full market cycle, risk catches up. So be wary of that. This is what it is: a conservative quantitative method to figure out the relatively stable ones. And I think it's a good starting point for you to start start looking for funds. And in most cases, you need 3-4 good funds, and it is important that you are involved in the process. It helps you, you know, stick to your plan. It helps you develop a belief in that, and that I think is the most crucial element in building long-term wealth.